Goldman Sachs, a name synonymous with success on Wall Street, has recently found itself facing a formidable challenge. In the past few years, this financial giant has experienced staggering losses in its consumer lending division, a move that some experts are deeming a strategic and financial misstep. So, how did one of the brightest stars of Wall Street transition from expressing confidence in its ability to build a profitable consumer lending business to admitting they may have done too much, too quickly? Consumer lending, comprising a mere 3% of Goldman Sachs' total revenue, might seem like a relatively small portion at first glance. However, within the context of this financial powerhouse, it carries more significant implications than mere numbers can convey. The fact that this small segment has caused substantial losses raises questions about the decisions made by the institution. In the eyes of the financial world, Goldman Sachs has built its reputation on being one of the smartest and most successful entities on Wall Street. Therefore, any misstep, no matter how seemingly insignificant in terms of revenue, casts a shadow over that reputation. This relatively small but notable failure in consumer lending prompts a closer examination of the strategies and choices made by Goldman Sachs. It makes us ponder whether there were underlying issues or flaws in their decision-making processes that contributed to these losses. Such questions highlight the importance of sound judgment and strategy even in apparently minor areas of a financial giant's operations, as the consequences can ripple through the organization and its reputation. Goldman Sachs' initial announcement of its venture into consumer lending was nothing short of a seismic event within the financial world. It reverberated through the industry, sending shockwaves of both excitement and intrigue. The very notion of Goldman Sachs, a venerable titan of Wall Street, making a move onto Main Street, where everyday consumers reside, was a concept that captured the collective imagination. It was, in many ways, a transformative shift for an institution primarily known for its high-stakes trading, investment banking, and elite clientele. This decision was not just about expanding its reach, it was about embracing disruptive change. The financial world had long associated Goldman Sachs with a particular image, that of a sophisticated, exclusive institution catering to the financial elite. To see them pivot towards a more consumer-centric approach was, in itself, a captivating narrative. As the news spread, all eyes turned towards Goldman Sachs. Financial experts, competitors, and the public at large were eager to witness how this transition would unfold. It was as though a curtain had been drawn back on a new chapter in the financial industry story, and everyone wanted to be a part of it. The move symbolized more than just diversification. It represented a potential shift in the balance of power within the financial sector. It signaled that even the most established players were recognizing the significance of technology and consumer-driven finance. In this climate of intense curiosity and anticipation, Goldman Sachs ventured into consumer lending, embarking on a journey that would be closely watched, analyzed, and debated. The financial world was witnessing history in the making, as one of Wall Street's giants took its first steps onto the bustling streets of Main Street, forever altering the landscape of finance. In 2016, Goldman introduced its first consumer product, the Marcus High Yield Savings Account. Shortly after, they ventured into personal loans, a move that sent ripples of concern through the consumer banking sector. You see, while there were plenty of fintech startups offering personal loans, they weren't seen as a major threat to the big banks. Goldman Sachs, on the other hand, posed a significant challenge. To build its consumer business, Goldman Sachs brought together a diverse team of experienced executives from the consumer lending world, the tech sector, and even its own bank. They believed they had an edge, thanks to their expertise in algorithmic trading, risk management, and digital distribution. But, despite all their preparations and confidence, it seems Goldman Sachs may have underestimated the challenges of consumer lending. Now, as they grapple with significant losses, questions loom large. Can they turn the tide, or is Goldman Sachs truly in serious trouble? In 2019, Goldman Sachs made a bold move by partnering with Apple to launch the Apple Card, marking its entry into the credit card market with much fanfare. It was a competitive space, one that other retail banks had dominated for years, but Goldman was undeterred. Their venture into the credit card arena marked the beginning of an aggressive expansion in consumer lending. The year 2020 saw the introduction of Marcus Pay, an installment payment product created in partnership with JetBlue. Goldman also secured the General Motors credit card, and in 2021, they came close to winning the JetBlue credit card from Barclays. These moves made it clear Goldman Sachs was becoming a major player in consumer finance. This new consumer-focused strategy was driven by David Solomon, who took the reins as CEO in 2018. He was committed to making Goldman a genuine player in consumer lending, with a wide range of products and services. However, not everyone within the company agreed with the direction it was heading. Some executives in the consumer business began to voice their concerns and eventually started leaving the company. The rapid expansion began to feel like a grand experiment. One controversial move was the development of a new cloud platform to manage consumer products. While some saw it as a game changer, others believed it was a costly endeavor that resulted in significant delays in product rollouts. As Goldman Sachs navigated this tumultuous journey into consumer lending, the company found itself at a crossroads. Would their aggressive expansion pay off, or were they heading for even more trouble in the challenging world of consumer finance? Only time would tell. Around the summer of 2021, Goldman Sachs took a significant step by striking a deal with home improvement lender GreenSky, but not without internal concerns. Some partners at Goldman raised red flags about the deal. The primary concern revolved around the fact that Goldman wouldn't have direct access to the consumer since GreenSky operated through intermediary contractors. Doubts were also raised about the pricing of the deal. These concerns didn't go unnoticed, and Goldman shareholders were growing increasingly frustrated. As time went on, more questions arose. Why was the company loading up on more consumer activities? Why were they attempting to do so much simultaneously? The various consumer products being developed were also incurring substantial expenses. Building these products, staffing up for them, and meeting regulatory expectations all stretched the timeline for the consumer business to become profitable even further into the future. These concerns gained momentum as the investment banking business slowed down in 2022 compared to its record high performance the previous year. Suddenly, it mattered that a business unit had high expenses, especially if it wasn't contributing positively to earnings. Shareholders appear to be more relieved as Goldman returns to its roots. Conversations with executives at Goldman suggest that, even if it results in losses on the pieces of the business they're selling off, investors are looking toward a future where Goldman Sachs is no longer a consumer lender. Well, that's it for now. Do like, share, and subscribe for more.